Joining us now is David Kelly, JPMorgan Asset Management Chief Global Strategist, head of the Global Market Insights. David, I got to start with you on Congress, on the House of Representatives. Historic moment. Speaker Kevin McCarthy, no longer Speaker. To what extent has this dysfunction, this instability in Congress been a force pushing bond yields higher? And what should we expect to happen with that from here?
I don't really think that's the key thing in bond deals. I think we certainly have seen a situation that as we've looked at the budget numbers at the end of the year, as we think about where we're headed going forward, and we look at the interest costs that's piling up, it's clear that the government's going to have to raise a huge amount of money going forward. Something like $2.5 trillion this fiscal year, perhaps closer to $3 trillion next fiscal year from capital markets. And that's a lot for the bond market around the world to swallow. But we should have known that beforehand. No, what I think is really going on here is we have seen somewhat stronger economic data. It looks like third quarter GDP is going to be strong. We got a good JOLTS report this morning. So it looks like the economy's got some resilience. And that, I think, is really what's been boosting bond deals. And then, of course, there are technical factors which, as people get sort of squeezed and have to reposition themselves, which are pushing those yields higher. But I think this is mostly about a resilient economy rather than the chaos in Washington. Now, I think the problems in Washington are probably having a negative effect on the stock market. The stock market does not like uncertainty, but I don't really think that should be pushing bond yields higher.
Okay. Got to wonder if we have to dust off the term bond vigilantes here, though. With 4.8% or thereabouts on the 10-year, David, I mean, do you T-bill and chill, to use, I think, Jeff Gundlach's term?
No, you don't. Not if you're a long-term investor. I mean, 2 years ago, you could get a 30-year fixed-rate mortgage for less than 3%. And there are a whole pile of people who are kicking themselves today that they didn't do that. And today you can buy a 10-year Treasury yield, a 10-year Treasury bond that'll pay you 4.8. You can buy a 30-year Treasury that'll pay you almost 5%. And that's a good deal. And the reason it's a good deal is because we believe that recession or no recession, inflation is going to come back down to 2% by the end of next year. Once you get past a lot of the fiscal stimulus and the effects of Ukraine, this is fundamentally a disinflationary economy. And if that is right, and if inflation does come back down to 2%, then today's bond yields are actually pretty good value for long-term investors. Of course, yields could go higher, but these yields are pretty good investment, I'd say, today.
Okay, and you say long-term investors should be in long-term assets. To what degree do you mean equities there, and do you have specific sectors in mind?
Well, I mean both equities and fixed income. The real point is that at times like this, when you've got a lot of uncertainty, people tend to hide in cash. But what we found is that if we are close to peak CD yields, and I still think that's the case, even with some of the rhetoric coming out of Fed officials, I think if anything, the pressure in the economy is growing here, the deflationary pressure. So if we're close to peak CD yields, what we found is you go back over the last 6 interest rate cycles, every single time turned out there was a better thing to do with your money than just park it in CDs. You tend to get either a big rally in the bond market, or you get a rally in the stock market, or both. So long-term investors should really try not to stick in cash just because they're scared. If you get into a diversified portfolio where the stocks and the bonds are zigging and zagging together, you will tend to get a better return. And people just need to remember that and not hide out until everything feels... markets don't settle down. Markets settle up. And, when all the uncertainty is gone, it turns out that the prices you have to pay are higher. So people shouldn't get derailed by this. I know Washington is looking a little chaotic right now, and this is scaring people, but they should stick to the long-term plan.